Hello investors. In our view, the Indian fixed income market is at a particularly attractive juncture today, given that this represents the confluence of positive short-term cyclical factors as well as positive medium-term structural factors. Let me take a few minutes to just take you through our core view with respect to the fixed income market, covering both these medium-term structural and short-term cyclical factors. Now, we think there are three elements to the medium term structural view on India bonds. The first is a very, very strong macroeconomic narrative. This in turn is composed of three large variables in our view: India's current account deficit, India's fiscal deficit, and the credibility that the central bank has achieved with respect to inflation targeting. Delving into each of this quickly. So, India's current account deficit now is probably structurally on a path of around 1.5% deficit as a proportion of GDP from 2.5 to 3% that used to be the case earlier. This is largely courtesy a $5 to $6 billion per month improvement in our services trade surplus, India being a large beneficiary of the services offshoring phenomenon that you are seeing. So, typically our current account used to compress if global commodity prices used to fall or growth used to falter. Now, the deficit is compressing because services exports are higher, and this looks like a structural trend to us. Turn to fiscal deficit. Unlike previous episodes where fiscal consolidation was either achieved through very strong nominal growth rate of the country or through aggressive divestment or pushing some of the expenditure items below the line, for example, food, oil, fertilizer bonds. Unlike those episodes, the current phase of fiscal consolidation is driven squarely by greater formalization and therefore larger tax buoyancy and judicious expenditure management, taking care that capex spending is not compromised while there is a lid kept on revenue spending. Further, the government is moving to a structured framework based approach towards fiscal consolidation, and that will give a lot of confidence to global investors. The third aspect is RBI's credibility on inflation, which over the last few years have been proven beyond doubt that RBI is a safe guardian of financial stability in the marketplace. So, not only are they a conventional inflation targeter, they have also had a judicious reserve accumulation strategy, and global investors are getting more and more confident that RBI will help to preserve the value of their investments in this country. So, this is the first set of factors which is a great macroeconomic narrative as far as India fixed income is concerned. The second is that over the last 5 years, we are seeing a significant rise in the share of long-term domestic investors in the India fixed income market, namely pension funds, insurance funds and the like. You can think about it as retail savings getting channeled more meaningfully into long-term bonds via these agents. This also looks to us as a trend that will continue. So, over the last 5 years, the share of these long-term investors in the bond market has risen by 5 percentage point. Turn to the third factor, which is India is now getting discovered more and more by global institutional investors as far as the fixed income market is concerned. Now, bear in mind that between 2013-14 to 2019-20, foreign FPI or foreign institutional investors, for whatever reason, were not investing in India bond markets as much, but all of this has started to change starting last year. The trigger point was really the JP Morgan index inclusion, but we think over the next 4 or 5 years, this is going to be a much bigger story than just one index inclusion. Very recently, the FTSE Russell index has also included India bonds, and that's a sort of acknowledgement by this index provider that India bonds are becoming mainstream in a lot of global institutional portfolios. As a reference point, FPI ownership of India government bonds is roughly around 3% of government bond outstanding, which is far lower than what a lot of our other peer markets have. And we do believe over the next 5 years, FPI ownership of India bonds is going to get much bigger. Now, if you combine these three medium term factors, which is a great narrative, rising long term investors domestically participating and larger ownership of FPIs, this is basically a very similar framework that the equity market as an example has benefited from over the last few years. And we think for the bond market also over the next 5 years, this will lead to better valuation of the market. Now, how do you assess valuation of bonds? First is term spreads in the marketplace may not rise much even as rates get cut, which simply put means that the curve or the yield curve may remain relatively flat even as the RBI is cutting repo rate, because more and more global investors are now discovering the Indian market. The second is the so-called real positive yield, which is nominal yield minus expected inflation. So, let us say take the 10-year point, where as we speak the 10-year is around 675 and the forecasted inflation is around 4.1. This spread will narrow as time progresses, because India bonds will command better valuation owing to the setup that I just took you through. Turning now to short-term cyclical factors. So, we recently had a change of stance from the RBI. We do believe either in the December or the February policy, the RBI will commence rate cuts. We expect around 75 basis points of rate cuts from RBI over the next 1 year. Even given that the repo rate is going to fall by 75 basis points, you are still getting the duration part of the yield curve, be it 5-year, 10-year, 15-year, 30-year, at a very healthy spread over the repo rate. So, bond valuations in India remain cheap. Also, a context investors should remember that the net rise in government bond supply is negative this year and it's going to be negative next year, which means that the net government bond issued this year are lower than last year and next year are likely to be lower than this year. So, you have a great format for fixed income in India, where you have a strong narrative, you have rising domestic long-term investor participation, you have greater discovery from FPI investors, you have RBI on the brink of a rate cut cycle, and finally you have reasonably cheap valuation with net supply not an issue at all. So, that is in summary our fixed income view. The inference is quite clear. Investors have to first and foremost plug their reinvestment risks by appropriate selection of duration as far as their risk appetite and investment horizons allow for.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.